Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at stock.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so this is a company that's been in the headlines for years now. A real turnaround story.
It absolutely is. And I think the core idea we need to unpack today is that they're finally moving past the promise of a turnaround.
And into the delivery phase.
Exactly. It's about seeing how far they've actually climbed out of that trough.
So if we're going to measure that, the best place to start is usually the numbers. What did the recent financials tell us?
Well, what's really fascinating here is that the Q3 2025 snapshot, it showed some real tangible momentum.
Okay.
Revenue grew about 3% year over year. That's up to $13.7 billion, which was a pretty solid beat.
And a beat is always good, but the top line isn't always the whole story, right? Especially in a turnaround.
No, not at all. The real story is inside the numbers, it's about the efficiency. That's what's stabilizing the whole ship.
And you see that most clearly where? In the margins.
Precisely. The gross margins. They rebounded to 40% in Q3.
Right. And that was actually ahead of their own guidance.
It was. And when you're pouring billions into R&D and new fabs, every single point of margin you get back is a huge sign.
It tells you the cost cuts are working.
They're working, and it shows that their focus areas are starting to, bear fruit.
So which focus areas are we talking about here? Where did that growth really come from?
It came from the targeted divisions. You saw data center and AI jump, I think it was 4%.
Okay.
And IFS, that's their foundry services arm, that was up 3%. So they are successfully zeroing in on those higher value segments.
The ones they absolutely need to compete long term.
Yes. But for me, the data point that really provides the proof of concept for the whole strategy, it's the cash flow.
The inflection in cash flow. Because for a company this capital intensive, burning cash can be fatal.
It can be. And that's why the free cash flow, or FCF, finally swinging positive in Q3 is such a massive, massive deal.
What was the number?
It hit $0.9 billion positive. And remember, FCF is the cash you generate after you pay for everything you need to maintain and expand the business.
So hitting positive FCF, especially after so many weak quarters.
It just takes the immediate liquidity pressure off the table. It validates the cost cuts, the asset sales, all of it.
It's the first real sign that they can start funding their own future again, instead of just, burning through capital.
And speaking of funding the future,
Yeah.
that stability got a huge shot in the arm from a major capital event back in August.
Right. That was truly a transformative moment.
It was. We're talking about the warrant and common stock agreement with the U.S. Department of Commerce.
This wasn't just financing. It felt more like a national security partnership, which makes it one of the biggest catalysts of a whole year.
It really is. The agreement locks in a commitment of, $8.869 billion in total?
And a big chunk of that is accelerated direct funding, right? Over $5 billion.
Over $5.6 billion. Just think about that. It immediately de-risks their entire capital structure. It gives them the flexibility to invest heavily in their roadmap without sweating every single expenditure.
It's like a shield against that capital intensity risk we were just talking about. But there are strings attached.
Important to remember that.
And those strings are tied directly to the operational execution we're all watching.
Right. This isn't just free money. Those future funding tranches, they're contingent on the company hitting specific technical milestones.
And this is the crucial part securing customer commitments for their foundry services.
Exactly. The government is basically saying, we'll fund this, but only if you prove the market actually wants what you're building.
Which shifts the entire conversation away from finance and squarely onto engineering.
Yes. Because at the end of the day, the money is just fuel. The entire turnaround hinges on tech execution. If they don't deliver, no amount of cash will save them.
So let's unpack that. The market seems to be laser-focused on one thing.
The Intel 18A node.
The 18A node. So for our listeners who aren't, deep in semiconductor fabrication terms, what exactly is 18A and why does it matter so much?
Think of the 18A node as their golden ticket. It's their next-generation manufacturing process. The smallest, fastest, most power-efficient process they plan to offer.
And they've had struggles with process delays in the past.
Huge struggles.
Wow.
They let competitors completely leapfrog them. So 18A is their chance to not just catch up, but to potentially leapfrog the competition themselves.
And there's a critical date everyone is watching, December 2025.
That's the one. The transition of the 18A foundry node to high-volume production, or HVP. It's probably the most consequential technical catalyst on the calendar.
So successful execution there proves to everyone.
It proves to the world and to those government funders that they can actually compete in advanced manufacturing again.
If they hit HVP, it validates the whole foundry division. If they stumble,
It undermines the credibility of the entire turnaround. The stakes couldn't be higher.
and you need advanced chips to put on that advanced process, what does the product's pipeline look like for 18A?
We're looking at the next-gen chips that will really support revenue into 2026, specifically Panther Lake and Clearwater Forest.
And when are those expected?
Late Q4 this year or maybe early Q1 2026.
Now, here's where it gets really interesting for investors, right? These aren't just any chips.
No, they are specifically targeting high-demand AI processors and advanced client computing, if they can deliver real performance gains there.
Then you'll see it in the earnings. It'll drive profits through next year and validate their return to product leadership.
It's a 1-2 punch, process leadership, then product leadership.
Okay, let's pivot to the really near-term stuff. The catalysts that could move the stock in the next few weeks. We have Q4 earnings coming up in January.
We do, and the guidance suggests we should be ready for revenues somewhere between, say, $12.8 and $13.8 billion.
And earnings per share?
EPS is guided pretty modestly, around 0.08 cents, but you have to contextualize that.
Right. That number reflects all the costs of these new product launches, the asset divestments like Altera.
Exactly. So the story there isn't just the number itself. It's about seeing continued progress on execution despite those heavy costs.
Beyond the hard numbers, though, the market runs on speculation. What's the chatter right now? What are the rumors?
The speculation really centers on three main things, all tied to that idea of validation.
All right, what's number one?
The big one, a potential foundry customer win announcement.
Ah, right. Because the government funding and the 18A credibility, it all hinges on signing big external customers.
Precisely. And rumors are persistent that a major customer announcement could land early in 2026. A single piece of news like that would be huge. It would instantly validate the tech.
Okay, and the second speculative catalyst, it involves those new chips we just talked about.
Yes. There's a lot of hope and speculation that Panther Lake and Clearwater Forest might outperform expectations in the early benchmarks.
And if they significantly outperform the competition,
You could see a big upside surprise in Q1 earnings as customers flock to the better product. That could lead to a major stock re-rating.
and the third rumor is more structural, right? About managing all this risk.
It is. That chatter is about strategic partnerships or maybe even a partial divestiture of the foundry division.
Bringing in a partner would share that massive investment burden.
It would share the cost and, more importantly, reduce the sheer execution risk that they're currently carrying all on their own. It's a smart strategic move people are watching for.
That's a lot of drivers. Let's look at the charts. Has the price action actually validated this turnaround narrative so far?
Oh, the charts absolutely confirm the story. The stock has seen incredible momentum. It surged over 120% between just August and November of this year.
And that wasn't just a blip.
No, this was a definitive, high-volume breakout from a very long-term downtrend. It signals a profound shift in how the big institutions see this company.
So that kind of sustained move suggests the big money is behind it.
No question. And if you look at the technical indicators, the framework is firmly bullish. It's trading above its 50-day and 200-day moving averages, which confirms a solid medium-term uptrend.
And the momentum indicators.
Things like RSI and MACD, they're flashing bullish signals. It suggests there's still room for accumulation. The stock isn't wildly overbought just yet.
So for investors watching the chart day to day, what are the critical levels to keep an eye on?
Okay, so immediate technical support is sitting right around the $33 mark. That level really needs to hold.
And on the upside?
The next major resistance is $42. That's the 52-week high. And if these catalysts hit, the technical targets could really extend up toward $50 over the next few quarters. The volume is there.
So the chart looks healthy. The government has de-risked the capital. Cash flow is stable. But there's always a but. What are the big risks? What could still derail this whole thing?
The risks are really concentrated in one area, operational execution. First, you have the sustained losses in the foundry division. It's still a massive capital sink. But the most specific risk is any kind of delay or unevenness in the ramp-up.
Specifically the 18A node.
We keep coming back to it because it is both the biggest catalyst and the biggest risk. If they miss that December HVP milestone, or if the initial yields are poor, that investor confidence, which is sky high right now,
It could evaporate.
it could evaporate overnight. because it calls into question their fundamental ability to execute on their own roadmap.
And we also have to remember that margin pressure we talked about earlier. They have to keep spending at a staggering pace.
That's right. The capital intensity is a constant pressure on margins. But look, management is keenly aware of this. They are actively mitigating it.
Through cost cuts, asset sales.
Aggressive cost cuts, monetizing non-core assets, and crucially, that strategic government and partner support provides a huge resilience buffer that, frankly, most of their competitors just don't have.
So if we zoom out one last time and look at the big macro picture, where do they fit?
Well, despite the cyclical risks you always have in the semiconductor industry, stock has this historical resilience because of its scale and its diversity.
Right. They're in everything.
They're fundamental to AI and data centers, critical to automotive, essential for national security, and the huge secular trend underpinning the entire AI market that provides an enormous multi-year tailwind. Demand for their product won't be the problem.
So they're perfectly positioned if they can execute.
That's the whole story in a nutshell. The next 3 months are an absolute pass-fail period for this company. We'll be using earnings, funding milestones, and customer announcements as the key barometers.
So what does this all mean for someone looking at the stock today? It really sounds like conviction has returned to the market.
It has. The market is finally rewarding the delivery of the turnaround, not just the promise. So I think the stock is attractive for both short-term traders looking to play these catalysts.
And for long-term investors.
And for long-term investors, betting on those huge AI and founder-year growth trends and their ability to hold on to their competitive moat.
Okay, so here's a final thought for you to think about as you watch this story unfold.
Go on.
That massive government funding, it all hinges on getting external customers for the 18A node. So the real tension next quarter isn't just the technical execution, it's which major company will be the first to publicly sign a big foundry contract.
And what that signals about 18A's true performance.
Exactly. That announcement, whenever it comes, will be the real turning point.